Here's a question that stops most retirees cold. Why would you put $75,000 into SPY, the S&P 500 fund, just to earn a little income on it, when you could control those exact same 100 shares for about $18,000 instead? Same exposure, less than a quarter of the cash, and because the cash you put up is the money you put at risk, less than a quarter of the risk too. And here's the part almost nobody tells you. That gap, all the money you don't tie up, is exactly what turns this into a retirement strategy. It's what funds your safety net and keeps a steady paycheck landing in your account without putting your nest egg on the line. So this video answers two things. First, why it makes sense to replace 100 shares of stock with a single leap call. And second, what a smart retiree actually does with all the cash that frees up. Because the exciting answer and the right answer are not the same thing. Quick note before we start. Everything in this video is educational only. It is not financial advice. Options involve substantial risk. Please talk to a licensed professional before you make any investment decisions. At the end of the last video, I made you a promise. I said we'd go under the hood on the boat, the foundation of this whole machine, and show you why it makes sense to replace 100 shares of stock with a single leap call. Today, I'm paying that off. By now, you know the two-engine machine. Engine 1 is your leap call, a long-dated call option that behaves almost like owning the stock. That's the boat. Engine 2 is the short call you sell against it for income. That's the rent. SPY is trading around 750 as I record this. So let's use real numbers and see why swapping those 100 shares for one option is the smartest thing a retiree can do with that capital. Start with the way most people are taught to do this. You want to earn income selling covered calls, so first you buy the stock, 100 shares of SPY. At $750 a share, that's $75,000. Real money and real risk, fully committed, sitting in one position. Then, and only then, you can sell a call against those shares and collect a little premium. It works. But look at what it costs you. $75,000 of your retirement savings locked into a single holding just to harvest income on it. For a retiree, that is a lot of eggs in one basket. There's a better way to get the same exposure, and it starts with one instrument. That instrument is the leap call. Think of it simply as a long-dated call option, typically 12 to 24 months until it expires, bought deep in the money. Two features make it behave almost like the stock itself. First, it's long-dated, so it sits in the slow part of time decay. It barely melts day to day, unlike the short calls we sell. It's stable. Second, we buy it at about 80 delta. Delta just means, for every $1 the stock moves, this option moves about 80 cents. So it tracks the stock closely, roughly 80% of every move, up or down. A long-dated, deep-in-the-money call at 80 delta is, for our purposes, a stand-in for 100 shares. Almost the same ride at a fraction of the cost. So here's the headline, side by side. 100 shares of SPY, $75,000. The leap call that stands in for them, bought at 80 delta, 12 months out, runs about $18,000. And those two numbers, 80 delta and 12 months, are the whole spec. So you can pull this up in your own account and check me. Same 100 shares of exposure, about a quarter of the cash. And since the cash you put up is the money at risk, about a quarter of the risk. That's just over 4 times the capital efficiency. $4 of stock exposure for every $1 you put up and put on the line. And the difference doesn't vanish, it stays in your pocket. You've freed up more than 3/4 of the capital you'd have tied up in shares, no longer trapped in the position. And what you do with all that freed capital is the whole point of this video. First, let me show you the part that gets people excited, and then why it's a trap for a retiree. It's called leverage. Say SPY rises 2% from 750 to 765. If you owned the 100 shares, you'd be up about $1,500, 2% on your 75,000. Nice, but it's 2%. Now the leap. At 80 delta, it captures about 80% of that move, roughly $1,200. But you only put up 18,000. 1,200 on 18,000 is about 6.5%. The same 2% move in the stock shows up as more than 3 times that on your money. That looks like magic. And this is exactly where a lot of people get the wrong idea about what this strategy is for. Because here's the trap. A trader looks at that and thinks, great, instead of 2 leap calls, I'll pour my whole 100,000 into them, buy 5 and control 500 shares of SPY. About $375,000 of stock. Maximum leverage. But leverage cuts both ways. The same leverage that turns a 2% gain into 7% turns a 2% loss into 7% too. Used that way, this isn't a retirement income strategy. It's a faster way to lose your retirement. So we do the exact opposite. The gambler pours it all in to control as much stock as possible. We use leverage in moderation, enough to keep strong market exposure for far less money, and then put the capital we free up into safety. The efficiency isn't a tool to swing bigger, it's a tool to buy safety. That one distinction is the difference between a gambler and a retiree, and it's the heart of how we use this. So let's make it concrete, with $100,000 and 3 ways to put it to work. Option A. Pour all of it into shares, about 133 shares of SPY. Full exposure to the market, but the entire 100,000 is at risk, with nothing held back. Option B. The classic covered call setup. Buy 100 shares for 75,000 and park the other 25,000 in treasury bills. Now 75,000 is at risk, and 25,000 sits safe. Option C. The efficient way. Buy 2 leap calls for about $36,000 total. 2 contracts control 200 shares of SPY, the most market of the 3. That's a touch of leverage, used conservatively. And the remaining 64,000 goes straight into treasury bills, earning around 4% today with no major risk. Now look across those 3 rows. The money at risk falls from 100,000 to 75 to 36. And yet option C controls the most stock of all 3. Meanwhile, the safety net grows from nothing to 25,000 to 64,000. That is the entire point. The leverage didn't make you bet recklessly, it let you control as much of the market as you want while putting nearly 2/3 of your savings somewhere safe. That's the retirement advantage. And you still collect your income the entire time. Each of those positions throws off the same fixed weekly paycheck we built in the last video, a steady draw of about 1/8 of 1% of SPY's price. Let me show you exactly where that lands in dollars. 1/8 of 1% of 750 is about 94 cents a share. Across a 100-share position, that's roughly $94 a week. 4 weeks in a month, and you're drawing about $375 a month per position, financed by the premium you sell like clockwork. Put that against the $18,000 you actually have at risk, and it's roughly 2% a month. And that's income alone, before any growth in the boat. Now, one important thing so you don't misread it. That $375 a month is what one position pays. It is not your ceiling. It's a building block you can stack. How many positions you run and how large you size each one against your account is its own decision with its own rules. And we'll cover that carefully in a later video. For today, just hold the idea. Efficiency lets you own more of these income engines safely than you ever could buying shares outright. Now let me be honest, because this channel doesn't hide the trade-offs. Leverage is real, and the leap call can lose value. If the stock falls, your 80 delta option drops about 80% of the way with it. This is not free money. That's exactly why we're careful about how we build the boat. We buy it deep in the money, at 80 delta, not some cheap, far out of the money lottery ticket that can go to zero. We buy it on broad index funds, not single stocks. So one bad earnings report can't gap us down 30% overnight. And we don't start a leap call just any day. We define the right entry, a pullback inside an established uptrend. So we launch the boat at a smart price instead of chasing a top. From there, we manage every position with rules. When to adjust, when to stop out. So a bad stretch can't take us out of the game. The efficiency gives you the room. The rules keep you in your seat to use it. We'll spend whole videos on those rules ahead. So let's bring it home. 100 shares of SPY ties up $75,000. A single 80 delta leap call gives you almost the same exposure for about $18,000, just over 4 times the efficiency. But the magic isn't that your gains get bigger. The magic is in all the capital you free up, and the diversification and the safety net it buys you, while you draw the same steady paycheck. Leverage used for safety instead of a bigger bet. That's the whole idea. Next video, we go one level deeper on that boat. Not the price of it, but the thinking behind it. Why the leap call is the foundation, and why the prime directive of this whole system is to protect it above all else. I call it the fishing boat. The boat is your leap call. The short call is the net you cast from it. And if you lose the boat, you can't fish. Once that clicks, every rule in the system makes sense in a way it never did before. Hit subscribe, hit the bell, and I'll see you in the next one.